Make this shift now to survive the next decade. Now, it's apparent that things are changing fast, and the world we're going into is not the same as the one that we are leaving behind. And if you don't change the way you look at things, change the way you think about things, you're not going to be able to navigate the markets. You're not going to be able to survive what comes next because things have completely changed. Now, while it seems that the world is picking up on this whole great reset narrative, 2030 you'll own nothing, seems like it's working, the rich are getting richer. Well, in this video, I'm gonna show you the small shift to your thinking through your money, through your investments, that can help you see clearly how to navigate this, because the information that you're getting is wrong and you need to change the way you think about it if you wanna survive and thrive what's coming. Now, I'm gonna give you some specific ways to do this. I'm gonna explain to you how to manage the risk and reward scenarios that you need to be paying attention to. So let's go. All right, we're gonna jump right into it. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything that you have learned is wrong. Now, if you wanna survive this next coming decade through the markets with your money, through your investments, you need to change the way you think about things a little bit, and then we call that a paradigm shift. Now, a paradigm shift is when you can look at the same thing but see something different. It's kind of like this. Everybody's seeing the path going this way, but over here, you see that you want to go down this path. And so the thing you have to understand is that everything is relative. Now, on this channel, on this show, I like to always pull things into perspective so you can understand them differently, so you can understand them from different angles, and that's what we're gonna do. Now, the thing that you have to understand is that everything is a trade. So everything in life has a trade-off. So in order to get more of one thing, you have to give up more of another. And when it comes to our money, when it comes to investing, everything is a trade. So whether I'm trading $1 for gold, or I'm trading $1 for Bitcoin, or $1 for a share of Tesla stock, or it could be €1 for Tesla stock, whatever it is, you're always trading one for the other. So you need to understand those couple things first off. All right, now the thing that you really need to get your head around, and I believe this is one of the key pieces to understanding how we're gonna navigate the Federal Reserve through the central bank era, right? The central bank put, where they're basically driving markets. And we have to learn to think about money and investments a little bit differently, and we have to think about them in terms of purchasing power. And so let me give you a couple examples to just kind of put your mind right here. So first off, in the United States, well, and everywhere around the world, real estate is really expensive, right? It's all-time highs, right? It's in a massive bubble, right? Is it? Well, let's take a look at this. Now, I've made some real estate videos. This is not a real estate video. This is just one point though. So if we look at things priced in what? So priced in dollars, right? Or whatever currency you have. So homes priced in dollars are very expensive. They've never been priced in dollars this high. But what about if we price them in something different? So for example, if we look at homes priced in US dollar versus rice. So what we're gonna do is go back to 1970. So 1971 is when we got off the gold standard. That's when everything got distorted. So let's go back 1 year to 1970. And in 1970, to buy the median home in the United States took 43,000 pounds of rice. Today, it takes 27,000 pounds of rice. So if you were using rice as your reserve currency, as your store of value, instead of dollars, homes didn't get more expensive, homes got cheaper. As a matter of fact, homes are half the price they were in 1970. Let's look at gold, something else we're going to talk about more today. So priced in gold, in 1970, it took 646 ounces of gold to buy the median home price in the United States. Today, it's only 194 ounces of gold. So again, I'm going to ask you, are real estate home prices expensive or are they cheap? Well, in dollars, they're very expensive, but priced in rice or priced in gold, they've gotten very cheap. They're actually less than half the price in gold. So if you would have been using gold as your store of value since 1970, the house is half the price. So hopefully you're getting this. This is the paradigm shift here. If you're only looking at things as trading with dollars, priced in dollars, things have gotten very expensive. But if you look at things as stores of other stores of value like rice or gold, they've gotten cheaper. So maybe gold isn't such a bad place to keep your money. As a matter of fact, where you park your wealth, where you store your value, it matters. It matters a lot. Now, let's look at something else that's pretty interesting here. Let's look at gold priced in gold. Now, what the heck do I mean about that? Well, I'm talking about gold stocks, all right? So gold stocks like Barrick Gold, you probably remember that, Warren Buffett, it was the first gold investment that good old Warren Buffett has made. It's one of the largest gold mining companies out there. And so again, we look at gold mining companies and we look at them priced in dollars. And are they cheap or expensive? But what if we looked at the gold mining stock priced in gold? And so let's take a look at that. So now what we can see is all the way back here in 2002, it was 1/17th of an ounce to get Barrick Gold if it was priced in gold. Then what we can see is that it went all the way up to a high right here of 190, and now right now it's back down to about 90. So we can see it's in this consolidation pattern when it's priced in gold. It doesn't look like it's at an all-time high. Now I expect that it could return to its highs of 117, which would bring it back down to here, which could push the price way back up. Let's look at one more. Let's be a little bit more broad. So let's just look at miners overall. So one of the best ways to buy gold miners as an index would be the GDXJ, which is the miners. And what we can see is that they've been stuck in a tight range for 6 years. Look at this. Since about 2015, 2016, they've basically been going nowhere when they're priced in gold, right? We have to get, so they've pumped it, about 35% of all dollars in existence today have been created in the last about 12 to 14 months. When you pump that much money into the markets, it distorts everything. And so we have to get a different picture. That's the paradigm shift that you have to get in. And so if we look at miners priced in gold, we can see that they're in this consolidation pattern, and actually they're forming this little bit of a rounding formation here. It's about 1/40th of an ounce right now. And we think that it could get back to the highs of about 1/3, which would be all the way back down here. So again, are gold mining stocks expensive or cheap? Well, when they're priced in dollars, they look pretty expensive. When they're priced in gold, they look extremely cheap. And as a matter of fact, they look like they're ready to have a breakout. Now, one of my good buddies, David Hunter, I've had him on my channel many times, Dave Contrarian, he thinks that gold is ready to make a big run to $2,500, silver to $50. This was as of a few days ago. And I agree with him. I think that we're going to see gold run to $2,500 pretty quickly. Now that's wherever it is today. It's $700 under the price of gold. But when that happens to the price of gold, gold miners will go parabolic. That's where we can see them go hundreds of times, if not thousands of times return. The only other place to get returns like this would be in cryptocurrencies. That's why I like cryptocurrencies, and that's why I like gold mining. Now, there is a difference to buying the physical gold versus the miners. So obviously, it goes without saying that physical, you can hold it in your hand, like this picture. I have it, I can keep it in my safe. A lot of people say that if you don't hold it, you don't own it. With Bitcoin, not your keys, not your coin, etc. And that's true. There is definitely truth to that. And in the end of a world scenario where all the power goes out into the whole world and we're in this Mad Max type world and I need to get the gold out of my safe and go use it to buy bread and water, sure, that matters. Now, whatever you think the probability of that is happening, then that determines your conviction, what you should do. For me, I don't really see that being super probable. Now, I do keep gold in my safe, but I keep a little bit. It's not as good at beating inflation because it's just the physical gold. It more keeps up with inflation. It doesn't really beat it. What I want to do is not just maintain my purchasing power, I want to beat it. I want to increase my purchasing power. So that's where I like to go with miners because they have higher returns and they're actually leveraged returns. Of course, it's simple to understand. If the price of gold goes up to $2,500, like I said, it's about $700 an ounce from here. Well, if I'm a gold mining company and I have 1 million ounces of the ground and it goes up by 700 an ounce, that's 700 million that it went up by. So it's a leveraged return. Now, they will have much higher gains. Of course, they can also be more volatile as well. So I do own some physical gold in my safe for end of the world scenario, but most of the gold that I own is in miners, these exploration plays. Now, I want to show you the thought process that I go through when I'm looking for these gold miners to buy. As a matter of fact, in the description of this video, I have a free guide that I use that you can download, and it just kind of walks you through valuation models, how I look at these. All right. Now, I know. Let me just hear it first. Like, gold hasn't been doing much since about August of last year. It peaked and it's been kind of down. It's bounced and it's just kind of range bound. But again, like what David Hunter says, I agree. I think we'll see 2,500 pretty quickly, which means multiple hundreds, maybe thousands of % returns on our gold miners. So here's what we look for. I like to look for location. I like to copy success. I like to make sure they have a good team. And let me give you an example of this. All right. So the first thing, again, you know, I've told you many times, I'm a real estate investor. I've been a real estate investor. Now there's 3 of the most important criteria when you're investing into real estate, and that is location, location, and location. You ever heard that before? And so I am going to use an example company that I'm going to actually evaluate for you. I am going to let you know in advance that I have been paid to review this company, so take that for what it's worth. I'm not telling you to buy this company, but I am going to break it down in real time so you can see what you should be looking for. And again, I have a free guide and report down in the description if you want to download that. All right. So that's out of the way. I'm clearing that up. I'm not telling you to buy it, but it is a good company, one I'm actually evaluating, and I'm going to break it down for you. So the name of the company we're going to look at is Starr Mining. This is the US symbol, STRPF. All right. Now, again, the 3 most important things: location, location, location. So this one is in Canada's Quebec province. Now, there's a lot of problems when you're mining across the world that you don't want to be in jurisdictions that could be hostile. So for example, they might decide to nationalize the mine and just take control. Potentially war could break out in that country, could disrupt the mining, etc. And so Canada is one of the best districts to mine in because it's somewhat politically stable. All right, obviously this last year, Canada's been getting a little crazy, but it's one of the best areas in the world to mine. Now, on top of that, it's in this area, it's a giant area that contains the most diverse collections of metals in the entire world. As a matter of fact, it's a mecca of all the metals, not just gold, but silver, iron, nickel, titanium, copper, and zinc. And these are big. Copper, nickel, these are really big because of the EV boom. So even if you don't believe gold's going to 2,500, do you believe we're going to need more nickel because of the solar panels, because of the EV, the batteries, the cars? Do you think we're going to need more copper? They're about to electrify the United States with this infrastructure bill. And so if you don't believe in gold and silver, I'm sure you believe in nickel and copper. And so it has all of that. And it's one of the most prospective geological terrains in the entire world for gold. So again, location, 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 it has that. That's what I'm looking for. All right, the next thing is that I use this all the time: success leaves clues. What I like to do is I like to follow other smart people or copy what other smart people have done because it takes a lot of work off of myself. And so as you might imagine, some of the best places to find huge deposits of minerals and commodities, again, nickel, copper, gold, silver, etc., would be where they've already found big ones, right? And so if we could find a spot right next door to where some of the largest mines are, we'd probably be doing pretty good. And that's exactly what we've done. There's a company called Amex Exploration, and they produce 10 million tons of ore on the property right next door to this one. Now, Starr owns the property right next to them, like I said, and they're using the same geologist, that's who finds the materials in the ground. They're using the same geologist that Amex did to find the gold in the ground right next door. Success leaves clues, same area, same people. It's in the main vein, so the way minerals run through the ground is through veins. And it's in the main vein, and that's where the mineral riches are. That's where they find all of that. So success leaves clues, that's something I'm always looking for. On top of that, I wanna look at the team. Again, success leaves clues. Now, if I can find someone who's been successful in one project and they go to another project, I would imagine that they've done a lot of work, because you don't want to have a big win and then go to a flop, right? So they've done a lot of work, a lot of due diligence, and also having good ideas aren't enough. You need a team that can execute. Now, one thing I like to look for is what the management is doing. We can see the management for Starr owns about 40% of the company. Now, I like this because I want to see the team has put their money where their mouth is. They have skin in the game, we'll call it. And so I always look for the management team. How much of the company do they own? If they only own a little bit, then that is a warning sign for me. Also, look for people on the team who have experience. And so the VP of Exploration, Yves, he has 40 years of experience in gold exploration and mining. Again, massive experience. If you came from the auto industry or some other related industry like that, it wouldn't be important. I want to know that he has experience getting gold out of the ground. He was a previous president and CEO of Vision Lithium. another mining company, and he's been responsible for some major discoveries in his career. So again, success leaves clues. We're following a good team. They have skin in the game. We're following a good person who has success getting gold out of the ground. Now, some of the recent success, again, that we're talking about is that STRPF has is the land next door, Amex. Their stock moved up 700%. Again, these are crypto size returns that we can get in the gold, in the resource mining space. Shot up 700%. And STRPF, right next door, it hasn't even doubled yet. It's barely even gone up. Now, it did shoot up about 60% in the last 6 months. It's up almost 70% year to date. But it has pulled back just a little bit in recent times, which gives us a good entry. Now, when prices go sky high, my phone starts ringing off the hook like every time Bitcoin shoots up. Is it too late to buy? Is it too late to buy? Or the other side is like, should I wait for a pullback? Should I wait for a pullback? But as soon as it pulls back, most people don't want to buy. Well, we are in a pullback right now. I think that's a good opportunity. We can see that Yahoo Finance says that it sparked a new Canadian gold rush right here. A pick for the most exciting gold exploration play in Canada's massive Quebec province, as we just talked about, is of course STRPF Limited. And so we can see that. Now, it's not just cheap. I mean, it's a pullback, which is good, but we can see that it's also a discounted price from the last financing round. So again, follow the smart, successful people. So they just had a massive money raise with some really big institutions, some very smart institutions that specialize in investing in companies like this. And we have an opportunity to buy in for less than they did. And that to me seems like a good idea. So that's the recent success. And then we want to always manage for risks and returns. Now, I know most people, and probably most people watching this channel, watching this video right now, are always hoping to get those 1,000% winners, 100% winners, 500% winners, 1,000, etc. And everybody's optimizing to make the most amount of money. But the real investors, the professional investors, Warren Buffett's of the world, Warren Buffett says the single most important rule is to never lose money. The second most important rule is don't forget rule number one, which is don't lose money. So real investors, professional investors, they don't optimize for the upside. They always manage for the downside. And that's exactly what we want to do. Because juniors are more leveraged to gold, they have way higher gains. We can easily see 500% returns, 1,000% returns on positions like this. But they're also more volatile and they could lose money as well. And so we want to make sure, so we don't want to just optimize for the upside and go all in. We want to manage for the downsides, manage that risk. Now, I would recommend, typically what I've learned as rule of thumb is never to risk more than 1 to 2% in one of these positions, 1 to 2% of your total portfolio. And there's 3 ways that we can manage risk. 1 is allocations. Don't invest all your money, keep some in cash. 2, don't invest all your money into gold. That's the allocation. 2, through your position sizes. Whatever you do decide to allocate towards gold, don't put it all into gold. Put it in or into one position in gold, put it into different positions within that gold allocation. And then 3rd, use stop losses. If the price of the gold stock moves down too much, close it out. Don't continue to write it down. What you want to do is you want to cut your losers short and let your winners run long. George Soros, not my favorite person, but is one of the best investors in the world as far as his track record, 30 years with 30% returns plus, and the guy was a beast, all right? And don't want to get into more on that. However, what's important to know is that he, I think, had less than a 60% win ratio. So you could win 5 out of every 10 positions or 4 out of every 10 positions if you kept your losses to 10% and you averaged 20% gains, for example. And so we cut our loser short, we let our winners run long, and so we need to use stop losses with that. All right, now that is how you find a good company. Now again, I'm not saying to buy Starr. However, it's one that I'm looking at. It is pretty good. Hopefully this was helpful for you. If you want to know how to find more like this, like I said, there's a free report down in the description below. You can download it for free. It's my gift to you. And let me know what you think. Leave me a comment. Do you think that gold and silver mining stocks could have the same returns as cryptocurrencies? We've seen it before. Leave me a comment and let me know what you think down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't like the video, give me a thumbs down, I guess. But at least tell me why. Leave me a comment. Let me know why you didn't like it. And that's what I got for you today. All right, to your success. I'm out.